There's different people that just find it exciting to expand their knowledge in a given area. But you have to be in love with the subject. You can't just be in love with the money. I've had the luck of meeting a lot of people that are unbelievably smart in their own arena and do some unbelievably dumb things in other areas.
While 90% of day traders lose money and millions watch their retirement savings vanish during market crashes, Warren Buffett has averaged 20% annual returns for over 60 years. Today, he's worth $128 billion. Yet most people ignore his advice, chasing complicated strategies and overnight riches. The average investor earns just 3.66% annually, while the market returns 10% because of one fatal mistake: overthinking. Buffett, who started with just $114 and turned it into billions, says successful investing requires just 7 fundamental rules. Not complex algorithms or insider information, just 7 straightforward principles anyone can follow. Today, I'll show you exactly what they are. Rule number 1. Never lose money. The first rule of investing is don't lose money. The second rule is never forget rule number 1. This famous Buffett quote isn't just clever wordplay, it's the foundation of his entire investment philosophy. When most people hear this rule, they misinterpret it as avoiding all risk. That's not what Buffett means. He's emphasizing the mathematical reality of losses. If your investment drops 50%, you need a 100% gain just to break even. This asymmetry between losses and gains is why preservation of capital comes first. Buffett implements this rule through a concept he calls the margin of safety, never paying full price for an asset. If he calculates a company is worth $100 per share, he won't pay more than $70 or $80. This discount provides protection against errors in his analysis or unexpected problems. Consider Buffett's purchase of Geico in the 1970s. While other investors fled during a financial crisis that sent Geico's stock plummeting, Buffett recognized the company's fundamentals remained strong. He invested heavily at a massive discount, adding a substantial margin of safety. Today, Geico is one of Berkshire Hathaway's most valuable subsidiaries. To apply this rule yourself, always analyze the downside risk before considering potential gains. Build in a margin of safety on every investment. Be willing to hold cash when suitable investments can't be found. Focus on avoiding permanent capital loss, not temporary price fluctuations. As Buffett says, in order to succeed, you must first survive. When you prioritize not losing money, you stay in the game long enough for compounding to work its magic. Rule number 2. Invest in what you understand. Never invest in a business you cannot understand. This straightforward wisdom has kept Buffett away from countless trendy investments that eventually collapsed. During the late 1990s dot-com bubble, Buffett famously avoided tech stocks despite criticism that he was out of touch. While others poured money into companies with no profits and nebulous business models, Buffett stuck with understandable businesses like Coca-Cola, American Express, and insurance companies. When the bubble burst in 2000, Berkshire Hathaway's shareholders were protected while tech-heavy investors lost fortunes. This principle doesn't mean you must avoid entire industries. It means you should be honest about the boundaries of your knowledge.
There's a lot to that, and knowing your circle of competence is where that perimeter is enormously important.
Buffett calls this your circle of competence. For decades, Buffett avoided tech companies because he couldn't reliably predict their future. But as Apple's business model became more understandable to him, a consumer products company with extraordinary brand loyalty, he made it Berkshire's largest position. To implement this rule, define your circle of competence, industries and business models you genuinely understand. Expand your knowledge gradually, but invest only where you can evaluate competitive advantages. Be willing to say, "I don't know," and skip opportunities outside your circle. Focus on businesses with predictable economics rather than speculative ventures. As Buffett advises, risk comes from not knowing what you're doing. By staying within your circle of competence, you dramatically reduce avoidable mistakes. Rule number 3. Think long-term. If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. This Buffett principle stands in stark contrast to today's frenetic trading culture where holding periods are measured in days or hours. Buffett's average holding period for his major investments spans decades, not years. He purchased Coca-Cola shares in 1988 and still holds them. American Express has been in his portfolio since the 1960s. This isn't stubbornness, it's strategy. Long-term thinking provides multiple advantages. It forces you to focus on business fundamentals rather than market noise. It reduces transaction costs and tax consequences that erode returns. It allows compounding to work without interruption. It helps you benefit from the market serving as a voting machine in the short run but a weighing machine in the long run. Consider Buffett's investment in See's Candies. When Berkshire purchased the company in 1972 for $25 million, it generated about $4 million in annual profits. Since then, See's has produced over $2 billion in profits for Berkshire, an extraordinary return requiring nothing but patience. To adopt this long-term perspective, evaluate businesses based on their 10-year prospects, not next quarter's earnings. Ignore short-term market fluctuations that don't reflect changes in business value. Think like a business owner, not a stock certificate holder. Use market crashes as buying opportunities rather than reasons to sell. As Buffett notes, the stock market is designed to transfer money from the active to the patient. By embracing patience, you gain a significant edge over most market participants. Rule number 4. Buy wonderful businesses at fair prices. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. This represents a significant evolution in Buffett's investment philosophy, influenced by his business partner Charlie Munger. Early in his career, Buffett focused on cigar but investing, buying deeply undervalued, mediocre businesses with just one good puff left in them. While this approach worked with small sums, he realized that truly exceptional returns came from owning high-quality businesses purchased at reasonable prices. What makes a business wonderful in Buffett's eyes? Durable competitive advantages, what he calls economic moats.
What we're trying to do is we're trying to find a business with a wide and long-lasting moat around it, protecting a terrific economic castle with an honest lord in charge of the castle. And in essence, that's what business is all about.
Consistent earnings growth with high returns on equity, low capital requirements and strong free cash flow. Honest, capable management allocating capital wisely. Simple, understandable business models. Apple exemplifies this approach. While not as cheap as traditional value investments when Buffett began buying in 2016, the company's extraordinary ecosystem, brand loyalty, pricing power, and capital return program made it a wonderful business at a fair price. This investment has since multiplied several times over. To implement this rule, focus on business quality first, valuation second. Identify companies with strong economic moats protecting their profits. Seek businesses that can grow without requiring massive capital investments. Be willing to pay a reasonable premium for exceptional quality. As Buffett explains, time is the friend of the wonderful business, the enemy of the mediocre. By owning wonderful businesses, compounding works for you rather than against you. Rule number 5. Be fearful when others are greedy. Be greedy when others are fearful. The time to buy is when there's blood in the streets. Though this quote is attributed to Baron Rothschild, it perfectly captures Buffett's contrarian approach to market timing. Buffett doesn't try to predict short-term market movements. Instead, he recognizes that markets swing between excessive optimism and excessive pessimism, creating opportunities for the disciplined investor. During the 2008 to 2009 financial crisis, while most investors were panic selling, Buffett invested $5 billion in Goldman Sachs and $3 billion in General Electric. These investments included favorable terms he could demand precisely because capital was scarce during the crisis. Both ultimately delivered billions in profits to Berkshire shareholders. Similarly, in March 2020 during the COVID market crash, Buffett purchased additional Bank of America shares at deeply discounted prices while others feared bank failures. Within a year, these shares had appreciated significantly. To apply this contrarian mindset, maintain cash reserves to deploy during market panics. Develop independent thinking that resists both fear and euphoria. Create a watch list of great businesses you'd like to own at lower prices. Exercise extreme caution during periods of market exuberance. Market sentiment indicators like the Fear and Greed Index can help identify extremes, but the real challenge is psychological. Having the courage to buy when headlines are terrifying and the discipline to sell or hold cash when everyone else is making easy money. As Buffett says, the market is a device for transferring money from the impatient to the patient. By mastering your emotions and acting counter to the crowd, you position yourself to benefit from this transfer. Rule number 6. Focus on value, not price. Price is what you pay. Value is what you get. This distinction forms the core of Buffett's value investing approach. While amateur investors obsess over stock prices and charts, Buffett focuses almost exclusively on intrinsic value, what a business is actually worth based on its assets, earnings power, and growth potential. He views stock certificates not as trading vehicles but as partial ownership in real businesses. This perspective allows him to ignore short-term price fluctuations. When Coca-Cola shares dropped 40% during the 2008 financial crisis, Buffett didn't panic. He understood that Coca-Cola's intrinsic value, its brand strength, distribution network, and consistent cash flows remained intact despite temporary market pessimism. To implement this value-focused approach, learn basic business valuation methods, discounted cash flow, earnings power value. Focus on per-share business performance rather than stock price movements. Calculate a rough intrinsic value before purchasing any investment. Update your valuation as new information emerges, not as prices change. Warren's famous example is the farm he purchased in the 1980s. He calculated what the farm could produce, estimated future commodity prices, and determined a fair value. Once purchased, he didn't check its market price daily. He simply collected the profits. This same mentality should apply to stock investments. As Buffett explains, games are won by players who focus on the playing field, not by those whose eyes are glued to the scoreboard. By focusing on value rather than price, you make rational decisions rather than emotional ones. Rule number 7. Stay within your circle of competence. Know your circle of competence and stick within it. The size of that circle is not very important. Knowing its boundaries, however, is vital. This intellectual honesty has helped Buffett avoid countless investment disasters. Most investors overestimate their knowledge and abilities. They chase trendy investments they don't understand or make decisions based on surface-level information. Buffett takes the opposite approach. He defines clear boundaries around what he truly understands and only invests within those boundaries. For decades, Buffett largely avoided technology companies because he couldn't confidently predict which would maintain competitive advantages. He didn't feel bad about these missed opportunities because he understood a fundamental truth: you don't have to swing at every pitch. In investing, unlike baseball, there are no called strikes. You can wait patiently for the perfect pitch within your circle of competence. To apply this principle, honestly assess which industries and business models you truly understand. Create a too-hard pile for investments outside your circle. Gradually expand your knowledge, but invest only where you have genuine insight. Remember that impressive returns come from depth of understanding, not breadth of activity. Charlie Munger emphasizes that knowing what you don't know is more useful than being brilliant. This intellectual humility gives you permission to say, "I don't know," and move on, a surprisingly rare quality among investors. As Buffett says, there are no called strikes in investing. You can stand there with the bat on your shoulder until you get a fat pitch. By waiting for opportunities within your circle of competence, you ensure that when you do swing, you connect powerfully. These 7 rules aren't complex trading algorithms or insider secrets. They're timeless principles that have guided Warren Buffett from $114 to $128 billion. Never lose money. Invest in what you understand. Think long-term. Buy wonderful businesses at fair prices. Be fearful when others are greedy. Be greedy when others are fearful. Focus on value, not price. Stay within your circle of competence. What makes Buffett's approach powerful isn't its complexity, but its simplicity. These rules have helped him navigate every market condition over 60-plus years: bull markets, bear markets, recessions, inflation, and technological disruption. The greatest insight might be this: successful investing doesn't require genius-level intelligence or insider information. It requires emotional discipline, independent thinking, and the patience to let compounding work. As Buffett famously said, "The stock market is a device for transferring money from the impatient to the patient." By following these 7 rules, you position yourself on the receiving end of that transfer. Remember, investing success isn't about quick wins or beating the market every quarter. It's about consistent application of sound principles over decades. Start with just 1 rule today and begin your journey toward financial freedom. If this video helped you understand these principles, hit like and subscribe for more investment wisdom. Share in the comments which rule resonated with you most. Remember, knowing these rules isn't enough. You have to apply them consistently through market ups and downs. See you in the next video.